God bless America.
Recording's on. You're good to go whenever you're ready.
Yep, I just gotta get my sheet out here. Yep. Okay. So, call a meeting of the Board of Finance of the Metropolitan District Commission to order. It's a regular meeting, Monday, June 24th. I would ask the clerk if we have a quorum.
We do not at the moment, but Citizen Member Sagai will be joining us momentarily. I just texted him and confirmed that.
Well, we can probably go forward with public comments relative to agenda items. Are there any public comments relative to agenda items? Any public comments relative to agenda items? Hearing none, move on. We can't do the approval.
Wet just joined, so we can do the minutes.
He did join?
He just joined.
Okay. Okay, item number 3, approval of meeting minutes of May 20th, 2024.
Move it. Second.
Are there any additions, deletions, or corrections to the minutes as presented? Hearing none, all in favor of accepting them as presented, signify by saying aye.
Aye.
Let's see. Item number 4 is the report from Clifton Larson Allen on the 2023 audit. We have Bob Barron.
Yeah, Mr. Chair, I'm just here to introduce Jessica Aniskoff, who is a principal. I guess formerly they used the name partner. Now it's principal with Clifton Larson Allen. And the audit manager for our audit this past year, Brandon Cathcart, is here. But Jessica is going to be doing the presentation, and we'll invite her up and get started.
I think you're going to pull it up on the screen for me. Right, so this is our disclaimer. I'm going to go past that one. So our agenda for today, I'm going to go through the terms of the engagement, an executive summary, some financial highlights, the federal single audit, our required governance communication, and upcoming GASB pronouncements. So for the terms of the engagement, CLA is engaged to express an opinion on whether the basic financial statements are presented in accordance with GAAP. We also express an in relation to opinion on the schedule of expenditures of federal awards. We express an opinion on compliance related to the major federal award programs. We provide a report on internal controls over financial reporting and compliance with laws, regulations, contracts, and grants, which is also known as the Yellow Book letter. And we provide a report on internal controls over compliance related to the major federal award programs that we test. So for the financial statements, the MDC received an unmodified opinion, which is a clean opinion, the best opinion that's available. There were no findings reported on internal controls and compliance over the financial statements, and there's no management letter in the current year. For the federal single audit, we had an unmodified opinion, again, a clean opinion on the major federal program, which I'll discuss a little bit later. And there were no compliance findings or significant deficiencies in internal control over compliance. Okay, I need to go to my cheat sheet because I can't read that all the way over there. All right, so up on your screen is an excerpt from the MD&A, which actually comes from Exhibit 1. So what you see are the full accrual statements. So there's a column for governmental activities, which includes your general fund or sewer fund, capital projects, clean water, debt service, and then there's a column for business type, which includes your water utility fund and your hydro fund. Over on the left are the categories of assets, deferred outflows of resources, liabilities, deferred inflows of resources. I just want to spike out those deferred outflows and inflows. What those are mainly pension and OPEB related. When the actuaries calculate the liability, instead of putting maybe the whole change of the market value through, they get kind of stuck into these deferred outflows or inflows and amortized over a period of time. So, the market is volatile. You might have change in assumptions, which changes those pension OPEB liabilities. Instead of running that change through every year, they're amortized to kind of try to smooth those changes out. So if you go to the total column at the bottom, the total net position, which is how much the assets exceeded the liabilities, it's 1.281 million, which was an increase, if you look at the far right column, from last year of about 104.2 million. 73 million was in the governmental activities and 31.2 million was in the business type. The major changes in the statement, your capital assets increased 91 million, 66 million in governmental activities, and about 25 million in business type due to additional clean water projects, and then for the business type, the water main replacements. The other big change in the statements was the deferred outflows and inflows of resources, which is why I wanted to kind of spike those out and explain them for your pension and OPEB liabilities, which I will talk about a couple slides down the road. So the second statement is the income statement, revenues and expenses. So just going and looking at the governmental activities, the total revenues were 184.5 million, total expenses were 117.7 million. And then with transfers of 6.3 million, the increase in net position for governmental activities this year was 73 million, bringing your total net position at the end of the year to 1,011 million. And then on the business type side, the total revenues were 110.6 million. Total expenses were 73.2 million. And again, with the 6 million of transfers, it brought the net change in net position to 31.1 million, ending the year with a net position of 269.7 million. So just to talk about a couple of the fluctuations, the governmental revenues increased about 10.8 million, which was based on 5.2 million in charges for services, which if you drill down even further, that was about 3.9 million in sewer assessment fees, 900,000 in sewer user fees, and 400,000 in miscellaneous revenue. And then the unrestricted investments increased about 3.9 million, and operating and capital grants increased about 1.4 million. On the expense side, the big increases in expenditure, again, related to pension and OPEB, which is why you saw those big change in deferrals as well. And then the internal service fund allocation that's actually split between the governmental and business type funds. So that caused a little bit of a increase in expenses in the current year. On the business type funds, so remember that was your water utility and hydro, revenues decreased about 4.8 million. That was about 8.2 million decrease in charges for service, but that was offset by about 4.8 million increase in investment earnings. And on the expense side, again, it was then internal service fund allocation, pension and OPEB, and about 3.8 million in repairs that happened in 2022 that did not happen in 2023. So going to the next statements, these are your pension and OPEB financial statements. So these are your fiduciary funds or your trust funds that you've set up to accumulate assets to offset that liability. So in the pension fund, the change in net position in the current year was 15.4 million. It was a good year for the market. The net investment in earnings was 26 million. So with your total contributions of 11.3 million and deductions of 22 million, the net position increased to an ending balance of 246 million. So similarly, in OPEB, the net investment earnings was about 1.3 million. The total contributions were 7.9 million, and the total deductions of 8.6 million, which had a positive change in net position of 571,000. So the ending net position in the OPEB fund was 11.8 million.
Can you just tell me where that is with relationship to last year's? Do you have the year before on the OPEB fund, 11 million? I'm sorry, am I missing it? Is it here or am I missing it?
The beginning, can I go back? Yeah, so the beginning of the year would be where your assets in total were, the net position beginning of year. So 230.8 million for pension. Is that what you're saying, or do you want to see the change in net position to the prior year?
It's the second line from the bottom. We went from 230 million to 246.
So we went from, on OPEB, we went from 11.2 to 11.8. That's
Correct.
okay. I got it. Thank you.
No problem. All right, so just looking at the net pension liability. So what this is your total liability less that net position on that previous slide. So the total net pension liability is 87.4 million, and it's about 73.81% funded. Last year was 97.8 million for pension. And the net OPEB liability is 126.9 million, or 8.52% funded, and last year was 124.9. So it did increase, but again, that is based on actuarial assumptions, what happens in the market, that you're going to see those liabilities go up or down.
And what we're particularly happy with these numbers is our funded ratio increased for both pension and OPEB year over year.
Any questions on that before I move on to the federal single audit or on any of the statements?
Mr. Chairman? Buddy? Got a question?
Go ahead.
On both of those numbers, where are the actuaries want us to be? I mean, how close are we to where they want us to be?
Well, I mean, the whole actuarial analysis where they make a recommended contribution is over time is to get us to 100%. They want to ensure that the assets are available when the liabilities come due. And so that number is really strong. 20 years ago, you saw some plans over 100%, but with the crash in 08, 09, some plans went under 50%, but in the 70s, low 80s is really strong. On the OPEB side, we're still in the minority of organizations that are pre-funding this liability with the establishment of the trust. And we're only 3 years in, and we've already north of 8%, 8.5%, and it's growing year over year. Less than 1%, but it's growing. And we get this, we get evaluation from the actuaries on our OPEB liability too, and they make a recommendation every year that we bring to you and you approve in September for the budget on how much to put in. But our goal is to continue to grow that as well. So yeah, we're strong in both. It's a real benefit, a credit benefit for the MDC when I'm presenting to the rating agencies, because they consider it very strong as well.
Thank you, Bob. Thank you, Mr. Chairman.
Mr. Chairman?
Yes, go ahead.
Not so much a question, but just a comment. And Bob is absolutely right that we should be very proud of these numbers. Well, you said OPEB, we're in year 3 or ended year 3.
It may be year 4.
Maybe for year 4.
24 is year 4, I think. Yeah.
Right, but I was wondering, because it's still a fairly new to MDC, and as you said, the vast majority of municipalities out there are not yet at the stage, even though they should be. Can we include where it says net OPEB liability in parentheses year 4, year 5. So it gives an indication that that number, if you look at it as a standalone, you go, yeesh. But if you know it's year 3 or year 4, that's a pretty good number.
I'll do exactly that. I'll give the trend from when we started funding. It'll start out at 0%, right? And it'll grow. And just to be really clear, we pay all our bills every year. This is pre-funding the promises we've made into the future. And so that's what the trust is doing. So yeah, it's really good, but that'll be a fun chart to put together. I'll do just that. I'll give the trend when we started funding it, year 1, 2, 3, and 4.
We also, I'm sorry, if you're done, I thought you were.
And Kelly just reminded me, I guess what's most important is the reason why we pay the actuaries to do the valuations is to give us the recommended contribution. It used to be called ARC, that's what we all remember it as, but now it's called ADEC. We fully fund the ADEC every year for the pension and OPEB. OPEB for the last couple of years we fully funded, so that's another credit positive for us.
Well, Bob, to say that, that 8% or whatever, wherever we're at with OPEB is good, after only 3 years or, in our 4th year, that's fine. It's not an arbitrary target, though. It's not just an arbitrary number. Our actuary have, calculated where we need to, or where we should be, let's put it that way.
Absolutely.
With respect to things like cost of medical services and prescriptions and so forth. So, and I expect to see some increase in that. I mean, it's pretty obvious that there's been significant increased costs or inflation in a lot of costs, and certainly in medical services and equipment and so forth. So, as we move forward, I think we still need to rely on the actuaries to give us an idea of what that target should be at some point in the future.
We just received pension. We expect OPEB soon. As soon as I have them both in hand, we'll schedule something over the summer and we'll present it in advance of our September budget meeting so that the Board of Finance has an idea of what's coming.
Okay, thank you. Please go back to.
No problem.
I don't think we have any. Yeah, we don't have any. There aren't any other questions at this point? Okay, go ahead.
All right, so moving on to the federal single audit, the total federal awards expended this year were $43.6 million. The major program that we tested was the Clean Water State Revolving Fund Cluster. So that, when I talked about our letters earlier and no findings, it is based on this program that we tested. So we had an unmodified opinion on this program, and we had no internal control findings on this program. All right, so as far as our auditor's communication this year, the MDC did implement a new standard, the GASB 96 subscription-based information technology arrangements. We short named that SBITAs. So that was implemented, or it was reviewed. And so on the letter that you guys received for the auditor's communication, there were a couple extra pages on past adjustments. So you would have seen the GASB 87 leases on there. An invoice that was in the wrong period is on there, and then the SBITAs are on there. So what that means is management has evaluated leases and SBITAs, and they're not material to the financial statements, so they're not included, but they are above the inconsequential threshold that we as auditors have to report to this board. So that's why you see them on there, but they're not going to have, in our opinion, any effect on the readers using the statements, so they're not, the full standard was not implemented as far as booking an asset and a liability for these items. Also inherent in every financial statements are estimates. This is an area that we look at as auditors. So you have the net pension liability and the net OPEB liability. These both come from the actuarial reports that we just discussed. Alternative investments, this comes from a third party. These are not necessarily actively traded. So there may be some estimations in there based on the timing of the audit report and the valuations of these investments. The claims incurred but not reported, this is your IBNR and your internal service fund. This again comes from a third party and what the expected claims are after year end that belonged in that period. The unbilled fees, these are in the water enterprise fund, and it's based on actual consumption readings and the rates, and then the number of days that are unbilled as of 12/31. So there's a calculation that goes into that unbilled fees, and it's something that we look at during the audit. And then any possible commitments and contingencies, which we send out legal letters for any cases that were identified, just to make sure that there's, if anything should be recorded for upcoming lawsuits, it's recorded. Right, so this year we had no disagreements with management. Management did not consult with other accountants, and what this really means is if they didn't like our recommendation or our discussions on something, they didn't go out and look for another opinion that what might have matched their opinion versus what we were saying. We didn't have any difficulties encountered in performing the audit. As I mentioned before, here's the list of those uncorrected misstatements, which is kind of a harsh term. It's just amounts that are above our inconsequential threshold that we have to disclose to you. And we had no independence issues. So our upcoming GASB standards. So for next year, or this year that we're in, but next year's audit, Statement 99 is an omnibus. It's kind of a cleanup statement. There's some small things related to GASB 87, the lease standard. Basically what these omnibus does is some questions might have come during the implementation that GASB wanted to clarify, so they kind of throw it all in these omnibus standards. We don't think anything's going to really affect MDC in there. Statement 100, which is accounting changes and error corrections. This is related to additional disclosure if you have an accounting change or error corrections. And again, we would address this one if it happened for next year. Statement 101 is going to be one that's going to require some management work for next year. That's compensated absences. So the MDC will have to look at their leave policies and possibly calculate additional compensated absence liabilities related to leave, like sick time that might not be paid out upon leave, but if the sick time is accumulated, what do you think you're going to have to pay out in the future? So if somebody's accumulated 100 days and they take 10 days a year, you're going to have to calculate your compensated absences to include those additional days, even though they're not paid out as of 12/31. So that's going to require a little bit of work, and we'll certainly talk about that more for next year's audit. And then for 2025, there's additional disclosure needed for Statement 102 for certain risks. GASB wants you to disclose concentrations or constraints. For example, if you have limitations on raising revenue or spending or mandated spending, or if your entire organization falls under one collective bargaining agreement, that might be a risk that needs to now be disclosed. And I apologize, there's a typo in this. It should say 2026 for Statement 103. This one's hot off the presses, came out a couple weeks ago. The financial reporting model. So this one puts some guardrails around the MD&A, what they want to see in that MD&A that's at the beginning of your statements. For the budgetary comparison, you're now going to have your original budget, your final budget, a difference, and then you'll have your actual expenditures and then a difference between the final budget and the actual expenditures. And then there's just some clarification on the classifications of operating versus non-operating revenue that you're going to have to maybe look at. I don't know that we expect any big changes there, but I honestly have not dove into this standard yet. It's relatively new, so, and it's also for 2026, so we will get there when we have that audit. So with that, or is there any other questions on the last couple slides, or any questions overall?
Is there anything else? Any other questions?
Not a
Mr.
question so much as a statement. I mean, it's an excellent report, and I think we ought to send this up to our detractors up to the legislature who claim we'd have no controls.
They get it. They get it already.
They do. Let's send it with a little bow around it.
Detractors?
Detractors, there are a few.
Really?
Yeah, one's from your town.
I didn't.
Maybe just to a few of them.
Yeah, just a few.
If I could just make,
Go ahead, please.
also make a comment. Thank you, Commissioner Adel. Jessica, you speak very fast. And there's a lot of stuff here that, you know, I look at it and you say it and you make a comment and I try to remember that and already you're on the next two. So it gets a little speedy for some of us. Now, I believe it's the case that you have been with us for multiple years. Is that a correct
Yep,
statement?
that's correct.
Yeah. So you've seen the progress over, let's say, 4 or 5, whatever that number of years might be, and you have the history. So if you wanted to look further, you could. But it has always been the case, as long as I've been on this committee, that when I began, if we were to issue a grade at the end of the report, it was for many years kind of a C- and a little iffy. But it has gradually grown in the right direction, clearly, quite well. And as Commissioner Adel just said, you know, it's a very good report, there's no question. And one of the things that I would annually look at carefully was this notion of the management letter, where you could look and kind of read between the lines. Sometimes you didn't need to, but read between the lines to say, okay, there seems to be some improvement. But I want to be sure that as a member of this committee and for the public record, that this process has improved not only steadily, but quite to a great degree, I think. I'm not you.
No, I agree with you. I remember several page management letter, not too many years ago, and then I know we
Right.
had a finding in the single audit report a couple years ago.
Right.
So yeah, it has gotten progressively better, and I think this might be the second or third year without a management letter.
Yeah.
At least the second, I don't know.
Yeah,
if
yeah.
it's the third.
No, you got it. But anyway, I just wanted to say that, and we certainly appreciate your reviewing it and your being with us consistently, because I think that's important as well, to have someone's eyes who are looking constantly and annually. So I appreciate that. I'm sure the rest of the committee does as well. So thank you.
Thank you.
Or anything else? Anyone online with a question? Anyone? I want to miss somebody up there. I have a question, and I'm not sure it's for you. I just want to, I had some questions that I sent to Bob a little while back regarding some of the requirements that our charter has with respect to financial reporting. And Bob is in one of his answers, we only got so far, and I decided I would wait, instead of emailing questions and answers back and forth, that we wait for a meeting. But I asked if CLA has the district's charter as part of your permanent record. I assume that you have a copy of the charter.
Yeah, we do.
Yeah, and what I asked about specifically, and I asked this of Bob, not of you, so, but in section 3 of the charter requires a number of different things in reporting, financial reporting, and 3.8 allows for expenditures, appropriations, and transfers to be made by staff without the approval of the board under certain circumstances. And so I asked about that as a, sort of management override of controls, possible management override of controls issue. And Bob's response at the time is that it's an internal issue whether the charter allows for transfers without board approval. It's an issue that doesn't impact the audit. So I assume that if it doesn't impact the audit, that you're not actually looking at this. This is an internal control. But but it is internal to the MDC, so it is part of reporting, finance reporting for the Board of Finance, but maybe not necessarily through the audit itself. Is that the way that I
Yeah, I
understood
think
that?
if we had a question on a transfer or didn't think something seemed right, we would go to management or the charter at that point. So I don't think anything arose to that level with the audit that we had to question management as to why something.
Okay, and one of the issues that it discusses in the charter is basically that there is supposed to be a certificate presented with like a surplus, before the surplus gets moved or transferred to different items and everything. And when I asked about that, Bob, this is a question for you, not for the audit. But we didn't have that completed yet. You said that we wouldn't know that all the expenditures and revenue may not all be cleared out for '23 until as late as May, and that you would report on that when we got to the final audit, so.
And this is the final audit.
Bob, could you get to microphone?
Sure. In this final audit, and we had an opportunity to share it earlier this week, is if you're interested, the audit itself, if you look at page 23, you can see that the unassigned fund balance for the general fund is $38.4 million. And the reason why I bring this up is because this is with regard to the fund balance policy that I'm required to report to you. So, and then 2 pages later on page 25, the total revenues is $93.8 million. This is the ratio that unassigned fund balance to total revenue that we have the fund balance written, that we believe that, and you approved, that we should keep a reserve at a minimum of 30% for that ratio and a maximum at 35%. But what happens if it falls below 30%? Well, then it's incumbent upon me to bring to you a plan where I make a recommendation to restore the fund balance within 3 years. But what happens if it's over the 35%? The fund balance policy says the district board will determine what's done with that surplus. Now, in the past, it's happened one other year, I think my first year when I was here, is what happened is we presented the surplus in June and made a recommendation in September that, remember, this is the general fund, which is the sewer fund, that it's predominantly funded by member towns tax, ad valorem tax. So we made a recommendation that surplus either are lessen the increase or keep the ad valorem flat in that given year. So that brings us to those numbers I just quoted. What about 2023? We just got the final audit, and I just gave you the unassigned fund balance and the total revenue. Well, that ratio is 40.9%. That's 5.9% higher than the maximum, which is the equivalent of $5.5 million. And so this is a number that the board will decide on how to allocate it. Will the board decide, and with your recommendation, to use that to keep the ad valorem down when we present the budget in September? Or maybe you'll use some of it to keep it, to lower the ad valorem in September to what maybe it would normally increase to, and use the others, the money for something else. That's entirely up to the board. But that surplus has now been reported. The ratio is 40.9%. The excess is 5.9%, which is the equivalent to $5.5 million.
Yeah, certainly, Bob, I wouldn't, this wasn't any kind of question about the numbers that came up in this, but this is a direct reference to the charter, which it says that, I think it uses the words director of finance, that you're going to certify this. So just as you said, we're going to be informed that there's a surplus, but you're going to certify it to us. That's what I was asking about, and whether or not the auditor had to get involved in that. Your answer was no, that this is an internal procedure and that the auditor's not involved in that. They're just, all they're doing is providing the audit and the numbers they came up with, but you're going to certify that to us, not the auditor. That's my understanding. It's 3.8 of the charter, I think.
Yeah, I guess I'll check with John Myrtle if there's a requirement beyond me delivering the surplus to the finance committee, if you want it on a piece of paper that says, I hereby certify that the revenues, and I'm happy to formally certify it, but in the past, we've done it as part of the budget process, saying, it happened one other year. This is my fourth budget season. So 2 of the years we just presented, no, we're at 33.2% or something, right in the middle of the fund balance, no surplus to discuss. But one other year we were over 38.1%, 3.1%. It equaled about $2.5 million, and the board elected to just reduce ad valorem. And so the same thing's going to happen this year. Now we have $5.5 million that's now been reported because the audit is final. And we'll make some recommendations in September, but we'll look forward to the Board of Finance recommendation to the full board on how to use that money.
I'm just asking that, if you can review the charter with John or whatever, and just see, what the requirement is, and then you can take care of that. You don't have to wait for a meeting. You can take care of that by, by presenting it to us and just send it to the Board of Finance members. So,
Okay, thanks.
I appreciate that.
Mr. Chairman,
Yes.
just along those lines, Commissioner Curry, I've asked Scott to present to Finance Committee well before budget deliberations some alternatives to use those surpluses, such as Bob mentioned, ad valorem, or rate stabilization funds, or COLA for retirees from years past, to maybe buying another water company. Who knows? Only kidding on the last one.
Yes, and then we are going to be prepared for that. And when Bob submits, as part of the agenda for Board of Finance, obviously we do a presentation to the board, this committee. We do a presentation to the town. So in that document, and I hope that satisfies the charter. I'll have to look at the charter, but in that document is where Bob documents the fund balance, which will be 40.9%, and then obviously we need to bring that down to 35%, which is 5.5 million. So we will do that as part of the process, and however the committee chooses to have that presented, we're happy to do that. There's going to be a lot of, we're actually looking at some other things on OPEB, which I don't want to get into because it's a huge topic. But there's other things that we're going to present to the Board of Finance in this coming summer, prior to the September meeting, to look at things that we might do or not do, depending on the committee's desire to use that 5.5 million. So we'll be prepared for that, Commissioner.
Mr. Chairman, if I may, there is one
Sure.
other important thing that I promised myself that I would share with you, because it was a bit of an effort, is on page 27 of the audit, under the water utility, almost at the very top, you will see a line item that says other assets equaling $2 million. It was really important to me, and Jessica worked hard through her local and national review committees, the appropriate way to show the $2 million that you set aside as a rate stabilization fund to offset the impact of the debt service associated with the money that we would borrow to institute the water master plan, Remember, we said in the first 7 years, spend about $4.7 million. If it was all issued today, that would cost us $3.6 million a year. Well, we didn't have that. That money would have raised the water rate. But what we decided, or what you decided and approved, is to set aside $2 million last year. And I'm sure there will be discussions in the future. Can we afford to set aside another $2 million this year? Because the spirit of that fund is that all the work that we're going to do to institute, at least for the first 7 years, this large grand master plan, we're hoping not to have an impact on the ratepayers' water rate. And so we're setting money aside to ensure that happens. And I thought the best way for this committee and the full board to see that is to see it in its own separate line item in the financials in the audit. And so you'll see that on that page number, the $2 million set aside in other assets. Should you elect to do another $2 million this year, next year, you'll see that at $4 million, and it will grow and still until we start using it to pay the debt service on the master plan. Okay, thank you.
Okay, thank you.
Bob.
If there are any other questions about the audit or for the auditor directly, nothing else? Well, thank you very much for the presentation. I really appreciate it, the work, and it seems like the staff and the auditors that were here had, a good relationship this year. So I'm glad to hear that as well. So thanks again. Appreciate it.
Thanks so much.
Let's see, item number 5, consideration and potential action regarding authorization for issuance and sale of general obligation bonds in an amount not to exceed $85 million.
Yes, every year we come before you and then we get authorization for me in my capacity as the chief financial officer to go to the markets. First of all, get a rating on the proposed debt from the rating agencies, S&P and Moody's, and then go to the market and sell our bonds to raise money for all of the projects we not only anticipate in the next few years, but also to pay us back for all the money we've spent on approved projects since the last debt issue. Right? So every December you give us a list of appropriations which are permission to spend. Sometimes we will start spending on those projects before I've actually borrowed the money to pay for those projects. So every summer we go to the market and we raise the money to not only pay ourselves back because we fronted the money for these projects, but to also fund the first couple of years of the projects in the future. So before you, the first request is an issue for us to issue not more than or not to exceed $85 million in general obligation bonds for our CIP projects in the upcoming year. We actually have 3 similar requests, but I can cover those individually, or I can give you an overview and then we could vote individually, however you'd like.
Mr. Chairman,
Yes, go ahead.
if allowed and with no objection, for purposes of discussion, I make a motion, we approve all 4 on the agenda, number 5, 6, 7, and 8.
Second.
I would just like to ask before we, and I don't have an objection to it, but there's a difference in the I'll say it's vocabulary between 5, 6, and 7, and 8. So in 6, it says the issuance and sale of general obligation refunding bonds. in the amount not to exceed 25 million. So can you at least explain for, the Board of Finance, each one of those and the difference in each one of these? That's
Sure,
all.
sure.
And then we can vote on them all together. That's fine with me. So.
Great, thank you. The item number 6, which is not to exceed 25 million for refunding bonds, that is kind of like when you refinance your mortgage for a lower interest rate. When you're doing it with bonds, it's just called a refunding. When we issue debt, we make a promise to repay debt over 20 years, but included in that promise is a call date that, hey, if we think the terms are we could get better terms as of the call date, which happens to be 10 years in this case, we can go out to market and refund those bonds. And that's what it is. We have 24 million and change of 20, the issues are given dates, the year that it's issued, and then A, B, C, depending on how many debt issues we had in that year. But this 25 million is for 2014A. It's the remaining debt we have, and we believe that we could go to market, pay all of our cost of issuance, and have an interest rate that will save us more than 2% net present value of the refunded bonds. That's the rule of thumb. Personally, I'm more conservative than that. I like to look for 4% because who knows what's happening on a market. We have to make a decision on the day of the sale. And sometimes the costs of issuance are a little different than you anticipated. But in this case, this one's in the money. It's north of 4%. So if we get to you give me the authorization to go to the market. If we get to the market and I can't cover my cost of issuance, if it's not a good deal for the district, we won't go through. But I have to get permission in advance to try to refund this debt. And remember what we're doing. We're saving money on the. Remember, we issue debts for 20 years. We're calling it 10 years later, 2014 to 2024. We're going to save a good deal of money. I think it's $750,000 is what it was in debt service payments for the last 10 years of these projects. So as with any refunding, as soon as the refunding is complete, I come back to this committee and I report on how well we did. So that's what the first one is new money. They call it general obligation bonds for 85 million. The second one is 25 million to refund that 10-year-old debt in 2014. I'd prefer to go to 8 and then I'll conclude with 7. If there's no questions on the refunding, I'll go to the next one.
No, I think everybody the understanding is that you don't, for instance, to put it in more general terms, you don't refinance your home mortgage to change the interest by like 0.5% or 1%. You wouldn't do it unless there was a significant gain and covered all the costs, the points and closing fees and all the rest. That's what you're saying.
Perfect. So on number 8, this is a revenue bond. Typically, you issue general obligation bonds when your guarantee for repayment is the full faith and credit of your ability to tax. And so for our CIP projects, we have the ability to tax our member towns to come up with the debt service to make the payments on these bonds. Now, for the $40 million in number 8, this is not a general obligation bond. This is a revenue bond. So what is the guarantee on a revenue bond? It's our ability to add that clean water project charge on everybody's bill. That money comes in and pays debt service on these clean water projects. And so, so it's a revenue bond, not our ability to tax member towns. It's our ability to add a rate to the ratepayers' bills. And so that $40 million, since we started the IP in, let's see, we did it in December of '22, I believe, was the big authorization. Then we did more authorization in July of '23. I think we've spent $37.5 million, and this number is 3 weeks old, and I sign bills every day. So it's probably even greater. But we've determined that our share that we're going to need to cover is going to be $40 million. And so that's what we're asking for permission, is to issue revenue bonds that will be paid for with a promise of that clean water project charge.
And you said you're going to go back to number 7, which is actually a reallocation of the proceeds to.
Yeah, perfect. Thank you. Then I'll go to 7, and I want to get it right because I rewrote the descriptions. And so it was really clear. Oh, yeah, if you have a printed copy, it's 7.1 in the page number. But remember what we're doing when we're borrowing money. We're saying, hey, I think this project is going to cost me $10 million. I think I'm going to spend it all in the next 3 years. When we bond money, we need to spend the proceeds down within a 3-year period. But invariably, projects are delayed or they take longer than we thought. Or they didn't start as early as we thought they would start, but we've already borrowed the money. And so at the end of the 3 years, I need to allocate that money. That's part of our tax-exempt bond issue, is that we commit that we will spend these funds within 3 years. So I have to allocate this money to projects that I've already done spending on, but I haven't borrowed any money for. And so what that does is when those projects come up for borrowing, I get to borrow less because I'm going to transfer this $14,757,000 from projects that are at the end of their 3 years, but not yet complete. And so we're just going to move those money into projects that I've already done spending on. And then that frees up the ability for me to borrow again to get the project done in the next year. So we're not taking money away from any project. We're just reallocating it so it's spent within the 3 years. Now, to me, $14.5 million or $14.7 million sounds like a lot of money. But so that's why I wrote this first page the way I did, is $236,000 of it is from a $110 million issue. $12,849,000 is from a $130 million issue, and $1.6 million is from a $75 million issue. So we're doing $100 to $200 million worth of spending each and every year. So to not guess perfectly to the tune of less than $15 million is not really unusual, and it doesn't take away from the appropriations you've given us on any projects. It's just my request for permission to allocate it to projects I've already spent money on so that I fulfill our tax-exempt obligation by spending these bonded dollars within 3 years.
Thanks, Bob. I really appreciate you taking time to go through that. And we had a motion, I believe, to combine 5, 6, 7, and 8. Was that what you asked? Yeah. So without any other questions or anything, so all in favor of signify by saying aye.
Aye.
Any opposed? Okay, so they're combined, so we just need a motion for approval on those, so. Is there a motion to approve?
So moved.
Okay, thanks, Commissioner Russo.
If I may, the motion made by Commissioner Curry was the approve 5, 6, 7, and 8. So I'd say it was,
I thought it was to
God, it
approve
was
combining them.
Fine.
To combine and
Oh,
approve.
yeah.
Yeah, so that's what we did. We did.
No, combine and approve.
That's
Oh, I'm sorry. I apologize, then. I thought you were just saying we should combine them. So if the motion was to combine and approve, then we've already done that, then. I apologize, so. Okay. Item number 9 is the discussion regarding monthly CEO cash flow and budget forecast reports.
I received a commissioner question, and it's a good question. I probably should have preempted it with an explanation to avoid the question, but they were looking at the actuals, the budget reports for sewer, water, and then hydro. And then the commissioner looked down the hydro actual column and said, it says negative $300,000. I thought that the hydro fund was generating surpluses every year. Why in the world are you showing an actual deficit there of 300? And the reason for it is when the hydroelectric fund was established, there was language that says that any surplus generated by the hydroelectric fund can be used to reduce the ad valorem taxes in the sewer fund. And so in each of the last 2 years, this is last year it was $1.5 million, and this year it was $1,554,000. We said that the hydroelectric fund has enough money to transfer to the general fund to keep the ad valorem rate from increasing. As a matter of fact, I think it's the 3rd year in a row that we've kept it flat. So one of the ways we did that is by transferring from the hydroelectric fund's surplus. But what is a surplus? It's just the collection of revenues minus expenses in each of the years that have accumulated over time. So how do I take from that surplus? The only way to take from that surplus is to allow the expenses to be higher than the revenues. And so what you'll see in that column is in the expense column, you'll see $1,554,000 going to the general fund. And so I would expect that you would see a deficit in that column. I not only want to talk about expense where you see the $1,554,000, but I also want to show in the revenue, if you look, it's easier if I just do round numbers, $1.5 million being transferred out. We're only showing $1.2 million coming from the fund balance in the hydroelectric fund as revenue. Remember when we present a budget every year, we do revenues minus expenses equals 0. They're balanced budgets every year for sewer, water, and hydro. So the reason why we only moved up $1.2 million into the revenue is because it seems like I'm going positive, negative, is because the hydroelectric fund continues to generate a surplus. You have $600,000 worth of revenue, $300,000 worth of expense, and so you have a $300,000 surplus. So we transferred out $1.5 million. How do we cover that $1.5 million? We only have to bring in $1.2 million. So at the end of the year, we expect the revenues, the $1.2 million coming up and the $1.5 million going out, along with all the revenues and expenses, to generate a $0 amount. But we're at the beginning of the year, right? We've moved the $1.5 million out, and we've moved the $1.2 million up. but the difference between the two is the negative 300,000. So it sounds convoluted, but it's the only way that I can get money from the hydroelectric fund into the general fund, and that's why it shows a negative. Now, when we had a pre-meeting on this, I promised to change that form, or at least add at the bottom, without the transfers in to revenue and the transfers out of expense, the hydroelectric fund for the first 4 months is X amount of dollars positive. And so that probably could have cleared it up in the beginning, but I'm going to be sure to add it next month. And so that you won't see that negative in the CAO report.
The only question that I, unless somebody else has a question first?
I just to clarify, I raised the question with Bob. And anyone who reads this report on hydro is going, why are we even in the business if we're losing money? Because that's what's reflected on that page.
Right.
So we need that asterisk with a little more information so that when people read that page, they can say, oh, okay, you transferred money out, you're running a profit, or you're not running a deficit in any event. And so there shouldn't be any worry. That's
You're right. We're certainly not losing money, and there's a potential for us to make even more. But my question is, so all the revenue expenses you're talking about for this, for hydro, have to do with the Goodwin facility at this point, because we don't have a hydro facility at Colebrook anymore.
Right.
That's correct.
Okay.
Yeah.
So the original Colebrook facility, all the revenues from that were supposed to be directed to the ad valorem. This is what I remember, and this goes way back, you know. So there are no restrictions like that. I mean, you can, at Goodwin, there's no restrictions on.
No, the entire fund, the entire hydro fund surpluses are going to the general fund to reduce ad valorem. Well, both.
Okay, so, well, you said general fund, not ad, my understanding was that whatever revenue, financial benefits were derived from the hydro was supposed to go to the towns through reducing the ad valorem. That's,
And the town's ad valorem is a revenue into the sewer fund, but it's also called the general fund. And so, put
Okay.
another way,
I
is
get
I
it, you know.
can't use that surplus to lower the water rate in the water utility fund. You're absolutely right. You
Okay.
remembered it perfectly. These surpluses can only be used to reduce ad valorem in the sewer fund. And
I
that's
just
what
wanted to
we've
make
done
sure
2
that it-
years in a row.
everybody else understands that as well.
I'm not sure I understand that.
Sure.
Well, it
You
was-
keep using the word reduce, and it doesn't necessarily mean that the ad valorem is going to be reduced, but these funds are going to be applied to the ad valorem.
Correct.
Right. So
and that's
if ad valorem was going up $3 million, and I don't know, and divide it by the 8-member towns, the moving money in from hydroelectric, $1.5 million, would mean I would only have to tax the towns $1.5 million. So it's reducing the amount that I would normally have to collect to cover our expenses in the sewer
It's a
fund.
revenue stream for ad valorem, so it may or may not reduce it to zero. We've been dealing with zeros here for the last 3 years, but it is used, and obviously the board chooses to use that. So the board could choose not to use that, revenue. I think there's, Bob, 7 million or in there.
Yeah, 7.9.
So the board could choose
Yeah.
to not use any of that money if you so chose. So, but yes, you're right. It's not it's just to be applied to the general fund, which in turn would increase revenues and obviously lower ad valorem.
And
And
it
just-
has the effect of reducing the
Right.
ad valorem. It doesn't necessarily, I know what you're saying. but
It
has
goes into a
effect.
pot,
Yes,
and then the board determines what the rate,
Yes.
tax rate will be,
that's right.
and then you've got your bottom line for ad valorem. So ad valorem could go up even though that money is applied to ad valorem.
I think what's important is you see the actuaries talk about this in OPEB and pension, but we also do it, and that's amortizing any 1 year gains or losses. And so that $7.9 million is what we have at the end of '23. What I do is I divide that by 3 and say, in the upcoming year, I would recommend that you use $2.5 million to support the sewer fund. And then in the next year, we'll see what the surplus is, and then divide it by 3 and move it over. Because the problem with, if you moved all $7.9 million over, and you either reduced ad valorem, in the next year, you don't have that one-time revenue anymore. So not only do you go up the 7.9 million, but you go up the natural cost for covering all your expenses. And so to avoid that large step in a rate increase, any one-time revenues, we recommend that you amortize it over 3 years. So I would say there's about $2.5 million from the hydroelectric fund that is available to support the sewer fund in 2025, and that'll be part of our presentation in September as well.
And we are going to, as part of this, there's a couple of things we're going to change here with reporting this, but we are probably, the operational expenses of operating hydro is not 300,000. We report it as 300,000 because we have staff that's literally applied to this department and their salaries and expenses. But those staff do more than just hydro. So it's the run of the river, it's the 50 CFS. So by rights, to be fair to hydro, we really should consider this year, Bob, breaking out that expense of what does it actually cost to operate the hydro facility versus operating the dam as it relates to the charter and the minimum stream flows. Two different issues. We just happen to be there, so we create hydro as part of that process. But we're gonna make some recommendations this coming year.
We don't have, if Commissioner DeBella was here, he's the only one, I think, that even predates my participation in this, but the reason that this was directed at the ad valorem, revenues are directed at ad valorem, is that the towns had to approve the financing of building of the Colebrook hydro facility, which was new technology back then and basically a major expense with the prospect of collecting a lot of revenue in the future, which it did until we turned it off when it was starting to fall apart, I guess. So, but anyway, that's why I wound up with that. So, okay, we're on item number 10. If there's no other questions about that, item number 10, opportunity for general public comments. Opportunity for general public comments. I don't see anyone here, so we'll move on to item number 11. There's nobody online either. Commissioner requests for future agenda items. Any requests?
Yeah.
Anybody online? Oh, go ahead.
I would ask that for a future agenda item, and I know Scott is going to pull up history that was done a few years ago regarding a COLA study for retirees, and put that on the agenda, at least for discussion purposes and information purposes.
Okay. So, COLA study for retirees. All right. Anything else? Hearing nothing else,
Motion to adjourn.
entertain a motion to adjourn without objection.